everyone. This is Paul Feldman, Insurance Newsnet founder, and I am here today with Ed Massaro. He's the CEO, CIO of Knighthead Annuity Life and Assurance Company. So, Ed, tell me a little bit about yourself before we get into your company, because you're basically a new entrant into the space, but have been here forever. And we'll get into the company and what you guys are planning on doing in the near future.
Sure. Paul, thanks for having me. I've spent about the last 30 years, hard to believe, in the financial services industry. First in the investment banking and leveraged finance worlds, likes of J.P. Morgan, Solomon Smith Barney, and UBS. So I was always in a credit and capital markets role. About 15 years ago, I moved over to join and help grow Knighthead Capital Management, which is a credit asset manager, manages about $10 billion of assets today. When we started, we were about 400, and I had been on the banking side of the business, moved to the asset management side of the business with my partners, and was really responsible for business development and the operations of the company and looking at new opportunities. And that's what really brought us to insurance. Really back in 2010, we were watching what both private equity, some asset managers were doing in the insurance business. I guess most notably what Apollo and Athene were doing, and folks like Greenlight Re and Third Point Re on the P&C side. As asset managers and credit folks, we really felt that life and annuity was a business we could understand. It had cash flows that were very much in tune with credit and originating credit and being able to pay people back with fixed income and floating rate securities. So our interest sort of shifted to what was happening in the market. How could we provide service and retirement services first internationally, and we'll get into that, and second, and now most recently domestically in the U.S. So my interest has always been, and my background has been right after college in credit, leverage finance, asset management, and as we all know, that's part of the big part of what drives our fixed indexed and fixed annuity market today.
So tell me a little bit about your company, where you're going with this, because
Sure.
it's always exciting to have a new entrant, or somebody that's, especially you guys, because you're already an A-rated company. You've been doing this for a long time, but to really, dive into this marketplace, I think it's exciting. I'd love to hear that story.
Yeah, I know. Well, just I'll give you a quick background. I mentioned, 2010 when we started analyzing the market. We actually started Knighthead Annuity and Life Assurance, and we'll talk about it. We have a lot of Knighthead, so I'll hopefully sort that out for you. But Knighthead Annuity and Life Assurance Company was our first carrier. Started doing business after 4 or 5 years of us analyzing the market in 2014. And we saw an opportunity to provide annuity product, not to the US, which is very developed, but to the international markets. So we started just selling MIGA and FIA product to non-US people. And what our view was, there was an underserved market, wasn't massive, but there was a need, there was a niche market, and to be a high service provider, provide transparent products. Uh, the international market uses it for retirement, uses it for accumulation, a little bit more so than the US. And we'll talk about, why we ultimately got into the US direct business. But as an example, very similar journey in a smaller market. We started, I think our first year we did 25 million of premium in 2015, and today we write just shy of 500 million. Again,
Wow.
smaller
Yeah.
for the US market, but we are the number one provider in the international market. Many of our clients and policyholders are in Asia, Latin America, parts of Eastern Europe, folks where they don't have access to dollar denominated annuities. We can sell them out of our Knighthead Annuity and Life business, which is based in the Cayman Islands. Our next line of business, though, as we grew, was, we saw a need for, I'd say, middle market US carriers in need of capital relief. They were looking for reinsurance partners. Plenty of great reinsurers out there, very large companies have been doing it for a long time. But in 2017, we jumped in and said, there's in the 500 to $1 billion of reinsurance flow premium, we see a real opportunity to provide good partnership to carriers in the U.S., many of which I know you know. And we started our reinsurance business. So what did we do? No blocks, no legacy. This was not a grow at all costs. It was let's find partners, let's learn the business, let's grow with them. So every transaction we have six cedent carriers on our books, all flow transactions, all multi-year. We've been doing at this for 7, 8 years with our carriers, and we went hand in hand with them, pricing monthly MIGAs and fiat product. So while we are quote unquote, as you said, new as of 2025, direct to the market, we've obviously learned a lot from our partners. We've seen, both the winners and maybe some mistakes that have been made over the last 5 or 7 years. But part of the ultimate plan was to find and capitalize our company so that we'd have three business lines: our international direct, our reinsurance business of US annuities, and then we thought and we believe that we could get a fair share of the US market directly. So we went out and acquired a carrier at 46 licenses, great people, some great systems. And from our perspective, it was sort of a really successful opportunity in that it didn't have any legacy business. It was really built, ready to get going, and
Mhm.
frankly, it just never did. But it had created the platform. So we stepped in, hoping to add a little bit of expertise and some capital, and we used that to launch, our U.S. direct product. Where really started selling in January of this year. So people often ask, hey, there's plenty of annuities carriers out there, and there's some great ones, and there's some big ones. We felt we'd take the same tact: high service, white glove service, boutique company offering competitive rates. We will ultimately grow, but it's not grow at all costs. It's let's find the right partners. Let's use our technology. The good news and bad news, right, is being a new to the market, you don't have legacy blocks, you don't have legacy systems. So we can choose, and others have done great at this. There's great companies who've done, and we try to be just like them in technology. But I think we've got fresh technology. We can turn premiums around. We can tell people where their policies stand. So while that's a big lift, but you have to do it carefully. And as my partner Mike Brandreit says, it's smart growth. We want
Mhm.
to make sure we're not falling down on our policyholders, our distribution partners, and that's the journey. And that's a shortened version, but that's 12 years at it. But we always wanted to get into the U.S. market. What we knew was you needed to be consistent, you had to have technology, and you had to have capital. So we're not in, out of the market. We have a plan. We think in 5 and 10 year sort of plans. We want to have capital so that we can be consistent. We can, when our partners, our distribution partners spend a lot of resources to partner with us, as do we. So it's not let's get into the market, then, oh, you know what, let's get out of the market. So we've started with a MIGA, and we'll develop fiat product. We might develop some FILA product over time, but it's really making sure we can be competitive and provide what we hope is at least best in class service to all of our stakeholders.
So when you say the US direct, sometimes people think that that's you're writing direct to consumer, but you're going to be
Sure.
do you plan on it sounds like you plan on using distribution.
So yes, thank you for clarifying. U.S. Direct in my comments were coming to the U.S. market. Right now, we're using independent marketing organizations,
Mhm.
IMOs, exclusively.
Okay.
We'll expand into the bank and broker-dealer channel over time. As an example, in the international business where we sell to non-U.S. people, all of that, 90% of that distribution is through banks and broker-dealers. So we're also somewhat unique. Most new carriers to the US come to the market like we did, use the independent or IMO channel, and then ultimately, after some time, go into banks and broker dealers. We're reasonably well known by a handful of US banks and broker dealers who serviced offshore clients. We'll ultimately, we think, partner with those folks in the US. But yes, US through distribution channels. We are absolutely looking at the direct to consumer channel. There's some of our peers who are, I think, doing some very interesting things and have been very successful in that market. We're looking at it. I think technology is going to bring us there. It's going to, I think, bring younger people, frankly, into the world of annuities at some point. But right now, I'd say we're starting more in a traditional way with some five or six, right? We have six right now, independent marketing organizations who have partnered with us to distribute our product.
So your first initial entree into the industry is MIGAs.
Yes.
What makes your MIGAs different, better, or more interesting for an agent?
So, so you know, as we've watched, right, and the MIGA market continues to be strong, and given the volatility in the market, everyone, including me, thought that maybe FIAs would dominate again this year. We'll see. MIGA's got off to a pretty good start. I think of the MIGA product as your fullback on the football team. You've got to have one.
Yeah.
It's got to be competitive.
Yeah.
I think we've created, look, they're commodity like, but I think they become non-commodities when you do a few things. You can answer the phone, you can issue the policy in a quick turnaround, you can answer people's most important policyholders' questions, and you can provide options. Our stay sale product 357, which is our MIGA branded product name, we offer clients sort of three three buckets. We have a liquidity product, which full service liquidity. We have a no liquidity product. What we found in the MIGA market, nothing. You've been doing this a long time. You sold many of these as well. There's some folks who are like, I'm not going to touch this money. I want the best rate in the market. We give them a simple interest rate. We show them the compounded rate, and they look at it and say, I'm not touching that for 5 years. I know I don't need it. I'll pick this option in your riders. Others say, I want to have an income product. I'm happy to have a nice big coupon crediting rate, and every month I'm going to do systematic withdrawal. And we're happy to price that and happy to take a certain business mix in that match so that we give that agent and that client a solution. And then there's some folks who are like, I don't really know. I might need the money. I might not. I might need to make withdrawals. I still want a competitive rate. So I think our stay sale with our liquidity and no liquidity riders and how we've priced those affords an agent to have those three discussions. There are others like that in the market, but I think if you have a good rate and you have that optionality and you also can answer the questions and offer service, it's gotten us some pretty good mind share. We're right on target
Hmm.
for where we wanted to be. So that's how I'd say we've positioned Stay Sale in a very full market. We've been at the top, frankly, not tippy top, but we've been near the top on rates. You have to have a good rate.
Yes.
But I think people will look at rate and look at those other things that say, well, how does this fit into my portfolio? And does it give me some optionality? So I think we've done reasonably well there, and the uptake has been what we'd expected.
So I know you do not have a crystal ball,
I
but
wish I would be here, but yes,
it appears that interest rates may come down this year, and I think that this might be the best time to be selling MIGAs.
you're spot on, Paul. You can actually see it in even the duration mix over the time, right? The market's been a pretty interesting one this year with the tariff
Yeah.
discussions and all. So people were on the sidelines and jumped in, but we can see it from our flow. The 3-year flow has started to slow, as I think the market and people say, well, I think now rates are coming down, so let me reach for some more duration. So we've seen a bit of a pickup in 5 and 7 year. Again, we have not launched our FIA product yet, which we will. But we see people looking for a bit more duration. Um, I don't have a crystal ball. I think rates will come down. I'm in the camp, or I guess we're in the camp, that there's probably one or two Fed cuts coming. But, I said, I've been at this a long time. When I started in this business, risk-free rates were 8%. So there's a different perspective. Rates are still reasonably high. I think when clients see 5 5.5%. That 5%, at least in the near future, seems to be kind of that magic number. I don't think it's going to go away, but yes, I think folks are really interested in, let me lock away some guaranteed income. The equity markets obviously recently have recovered, but boy, they've been volatile, right? So if you're nearing that time when you'd like to see some of this capital come back to you, it's not a bad time to be grabbing a fixed product. So we're seeing that in both the duration flow and frankly our weekly inflows that we've seen in the first sort of almost 6 months of the year.
So from what I've seen, you guys have some kind of innovative riders. Tell me a little bit about that.
Thank you. I'd like to say innovative, but essentially we've just given people the ability, to have withdrawals or systematic withdrawals. MIGA products are either full service, like, hey, here's one price, and you can take your 10%, you cannot take your 10%. We've kind of got this mix where we'll give you we think a very good rate if you take no withdrawals, because obviously we can then look at those cash flows and they have a different liquidity perspective and a
Hmm.
different pricing, so we can price it and make a reasonable spread there. Or if we have to think about, client behavior or experience, puts a little more optionality into it. Actuaries, why we have them all around and give me the cost of liabilities. Um, little lower rate there. So, but I think both of those have to be competitive, and both of those options give that um, optionality, if you will, to our agent to see what's best for their client. Outside of that, I would say we're very traditional as it relates to kind of what is offered in Amiga. We want it to be transparent. I think you'll see us do the same thing when we come to market in a quarter or two with our FIAs. There's a lot of complexity in the market. There's even a lot of complexity in some MIGAs. Our approach has always been, hey, let's have enough complexity or enough experiences in there that people can get what they want, but not too much so that people have trouble understanding it. And that's kind of where we're trying to fall out. And I think you'll see us over time with all the new products we release.
So this is a question that may or may not make any of this interview,
Sure.
but I'm going to ask it. Last week I was at 9 different banks and indices, and now I have all kind. They weren't around, so I've got other follow-up meetings. There's so many indices out there. There's so many ways of doing it. What are you guys thinking as far as, which route you're going to go? Are you going to
Sure.
be like the Standard and Poor's model, or some of the other models that either may be aggressive, um, but do have really good track records? What are your thoughts on that?
Sure. It's a bit early, but I'm happy to tell you, Paul, what sort of what's happening inside as we think about this launch. Our fundamental is we will absolutely have a base S&P option. We will absolutely have a fixed option. The indices, we think, in our first product, there'll be 3 to 4, volatility controlled indices. But I don't, I'll be careful, right? Because aggressive. I think there's been some terrific indices. I've watched some of our peers come out with great product, really been successful. When rates went the other way back in 2020, you saw some options that had bond components or fixed components that really underperformed the market, and people still haven't dug out of that, in my opinion, dug out of that hole.
Hmm.
I think our approach will be a competitive group of indices, but we expect 50 to 60% of the clients we're going to be looking to attract to take just the plain old S&P option as an example. But will there be a balanced option? Will there be an all equity option? Will there be sort of a balance with maybe a commodity component? Yes, but I think it'll be with indices that are well tested, that will give you good performance, but most important, won't have any special. And people know that this was when they chose a certain index, there may be some lack of participation. We really don't want to be in the aggressive side where, boy, if things turn the
Yeah.
other way, you're going to look back and say, well, the market was up 7 or 8% and I was zero for 5 years straight. That's not, and maybe that person can be up 20 in one year, but that's not our first foray into the market. I think over time we'll offer maybe some income product too, but we're going to come into the market as sort of a competitive, transparent, high service model to establish ourselves. Because again, we're thinking over the next 5 years, where do we get to, and what does our product portfolio look like? So that's our current thinking. Don't want to put a date on it because we want to make sure we get it right. But sometime this year, you should see a FIA offering from Knighthead Life.
That's fantastic. I mean, and going back to what you had said earlier, being consistent is important. And the market hasn't always seen that. Some of these companies come in really high and then they're gone.
Big bonus, right?
And
Big cap. I think you said it early. While we were reasonably known in the States because of our international business, as an example, we sell FIAs internationally. We have never changed a cap rate in the 10 years we've been
that's
operating,
strong.
right? So we don't want to come out and we see the market, right? And there's a lot of replacement going on and rates have moved and folks are saying, well, with a bonus in the first year. And by the way, I think the industry's done a terrific job especially recently, that people say, hey, you're getting a big bonus, but don't expect this cap rate to be this high in year two. So that disclosure, as long as that's disclosed, that's terrific. Not probably how we're going to approach the market. We'd want to say to folks, hey, here's your guaranteed cap or par rate, but we're not pricing it such that we can't afford it. We think that's the best way to garner sort of long-term following and hopefully some additional good distribution partners. Look, we've got 6 right now who've been terrific to us, many of whom don't sell a lot of MIGAs, but they've said, we like the story. We kind of like your rating. We like the capital you have. We'll start, onboard us. Don't expect a lot of MIGA flow because principally 80, 70, 80% of our business has been FIA. And we're like, listen, it's great. We want to, you get to know us. We get to know you. When we come out with other products, it doesn't take the time to onboard. We've got our systems connected. So far that works, and that's how we hope to continue, to roll forward over we talk in 5 years, but we look in weeks. We roll out,
Yeah, I know. That's
look
how
in
it is,
months, right?
right?
You know how it works, right? We've got to make sure, the 1035s are processing. There's new technology coming through every day. We're on the cutting. We hope to be on the cutting edge of all that, so that we can be as good as anyone in the market as it relates to process time and giving clients the experience they expect.
So one of the things that you said that was interesting was that you are not really a legacy company that's in this space and that you could have some of the newest and best technology. Tell us a little bit about that.
Sure. Well, we use a base system that others use, but what I think the real value is in the automation, and everybody talks about AI today and what does it mean, but clearly our industry is ripe for some smart technology in processing IGO and NIGO applications.
Hmm.
I don't ever want to see it really. This is our view, really customer facing. Maybe someday we've all got on the phone with the auto robo
Yes.
answer. I think our business is not there, and I don't want it to be there. I think if we can automate some of the mid and back office pieces, that frees up my colleagues to really spend time with agents and a lot of times with the policyholder themselves. So whether it's smart technologies to make sure applications are full, we've got addresses, how the detail
Yeah.
involved in this, whether
Yeah.
we've got transfer papers in place, are we contacting the right carrier, Do we have our, license checks, which a lot is automated already, but we've spent money on technology, both internal with our with folks that we've hired as directly, but also have used outside consultants, which have really been helpful as to relate to both benchmark us against who we see our bench as best in class. E-apps, 95, 98% of our business. Again, we're new, so it's unfair maybe to compare to the older carriers, is all e-app. We have not developed our own e-app. We're using Hexure to do that in Firelight, and we're using some other
Good
vendors
company.
right now. We have for our international business our own electronic application as an example. So I think we have a good mix of in-house program and technology, as well as what we believe are using, some of who we think are the best service providers, whether it be, um, you know, software or people, and really just know-how in the industry. So we're doing, and we're watching. This every month I get almost every month, get a new call about some new technology. Maybe either we self-administer, and I believe we will always do that, but it doesn't mean you have to do everything.
Yeah.
And there are great partners and vendors out there, service providers who are really coming to market with some terrific technologies, whether it be contact call center, um, whether it be application processing, new e-apps that you can tack on to your core administration. What we got to do, we got to calculate people's account values. We got to give them their systematic, withdrawal payments right, and report, to our regulators and stakeholders. So that box is there. But what faces the outside and what processes it in our workflow, I think we're in a great spot, and others are availed to these same technologies, but not having a billion or 5 billion or 50 billion of policies on, a system that's 8 or 10 or 12 years
Yeah.
old affords us a little flexibility. Someday we'll be there, right? And we just have to keep up. So I think we're in a good spot and we're executing on that. But every, we have a 5-year plan to go from doing, the volumes we do today to, multiples of that. We expect to do hopefully 2 billion plus in the near term here of annual premium.
Wow.
Now that'll depend on the market. That'll depend on our competitiveness, obviously, but we don't see, given the demographics that you know better than I, and the retirement market in this country, we think there's enough room for plenty of good competitors to take a little bit of market share from folks.
Yeah, there's so much market out there that I hate to say it doesn't matter, and that another competitor helps lift your tide and everybody's tide, the industry's tide. So I
We
think it's great to have new entrants into the marketplace and for other people to be telling the stories out there.
on that front, we have, as I say, 6 carriers that we reinsure for. Um, I'd say most of them would perceive that, okay, now you're our competitor, but they really don't think that way. They're like, hey, Knighthead's been our partner. We have a standalone. We have a standalone executive team in Cayman who's responsible for reinsurance. They do not interact with the folks at Knighthead Life who sit in Charlotte and are responsible for our direct business. But all of this stuff is in the market, right? We can go to Annuity Rate Watch and you can see where XYZ company's rate is. You can see where Knighthead Life's rate is. And as long as we treat people fairly, can support their right, they're like, well, happy that you guys are in the market with us, just with the other 100 carriers. If you operate, I guess, professionally and reasonably, which I hope people think we do. And so we both have reinsurance clients that we support, and we're sitting right there next to them on the page in on Annuity Rate Watch selling. Not always in the same channel. There's different IMOs. There's different channels. You know this, Paul, the market. How
Absolutely.
so? I think, as you say, there's plenty of room. There's what we don't want. I don't like to see bad things happen in our industry. I
No,
want
nobody does.
carriers, right? I want carriers to, if they take some business from us because they've got a better product or their rates are higher, then so be it. As long, and I think the industry's come and done a great job. There's been a lot of new entrants, most of who are very professional. The private equity crew everybody was very concerned about PE backed insurers and
Yeah.
life annuity folks. I think the proof is in the pudding. Most have really performed exceptionally well, put a lot of capital, put a lot of technology. We hope to be grouped in that same vein.
So what can we do as an industry better?
You know,
With a,
it's
with a fresh, I hate to say with a fresh set of eyes, but from your perspective, what can we do better as an industry?
I think we touched on it a little bit before. The average age, I think industry wide, maybe, and you might know this stat better than I do, but it's mid 60s. Our book, which is very young, frankly, it's low 60s. It's 59, 60. I think given the market, the volatility, quote unquote, younger people are starting to look at this product as there's a place for it in its portfolio. And I'm not talking 20-year-olds or 30-year-olds, but is a 55 or 58 or even 48-year-old person, does it fit a starting spot in their portfolio and roll it a few times? I think as we get more, and there's some great new carriers out there that have done, I think, a terrific job on their, whether it be social media, their web presence, just their technology base with e-apps and apps on even phones, that I think we're missing on maybe the next generation. I think also there's this history of what happened to variable annuities, what were people selling in the old days, in the 90s, all of that were people gouging on commissions. I think all of that stuff painfully has been cleared. I think as people start to look at rates and the withdrawals, and everyone has said, "Oh, you lock up your money and you can't." We just need to continue to do a good job of, no, here are the terms. Yes, some of the fees are complex, but really look at your options. Are they really that complex? Are they much different than someone buying some ETF or
Yeah,
another
because
type of
God knows what
security?
happens in an ETF.
Right? So there's, and I think transparency as who the carrier is. Make sure you're, in my view, buying from a rated carrier, one that has good capital behind it. Maybe obvious statements, but I think if we do that and talk about how this is regulated, I mean, people say should be regulated, centrally. No, I think there's really high touch state regulation on insurance companies, and why there have not been, that many rehabilitations ever over time, and because you can't run away with it. So I think the industry has got the right backing here, and the products are becoming really competitive. It relates to other either fixed income solutions, other retirement solutions, um, as long as we can do that and make sure we make whole and make good on our promises, we tell that story. I think, there's a way to grow the annuity market. And you see it a little bit, right? We've seen a lot of replacement. Seen a lot of people who had 3, 5, 7-year-old MIGAs at much lower rates. There's been a big chase for, let me go make sure I don't lose that business. But how do we grow the market? And boy, I don't know, what's the stat? A billion people are going to be over retirement age in the next 10, 15 years. There's a lot of new folks we can at least hopefully reach out to and see if they think like we do that this is a good product, and it shouldn't be all of their portfolio, obviously, but a good product, you're in the portfolio. I kid, I have friends who, we're at that same age, late 50s, early 60. They go, "What are you doing? Yeah, annuities?" And I start telling them, I go, "Hey, I'll take one of those." And no one's reached out to them. There's people with multiple licenses in the IMO channel who sell securities and insurance. I think there's a whole other group of agents and advisors out there who we can maybe reach out to and educate and say, you know what, this annuity seems like it might fit in the right spot.
Yeah, it seems to me in the industry, it's a lot of the business that comes in is either replacement or it's a rollover from a retirement account.
60%, right?
And it's not a lot of new money. How do we get more new money? And you may have already answered this,
No, no,
but I'll ask you again.
no, no, please, and we can. I will repeat myself. I'm sure you can cut it.
It's all good.
But it is that bit of okay. If you look at the lack of sort of the old defined pension plan, people working in what I'd say is more entrepreneurial like businesses, and then you look at the stats of how much money they have for retirement. What is it, 62, 65% people fear more of running out of money than dying? I mean, we have a $41 trillion underfunding in this, and that's a broad number for retirement.
Mhm.
So they're there, and people do it with 401k, you do it with IRAs, all great products. Should there be a more of, hey guys, you can really plan and protect, recharter. I'll use our little tie line for your retirement with these products. So it's an education. I think companies I know four or five that I think very highly of that are similarly situated to us, but maybe 3 or 4 years ahead of us in the U.S. market at least, have done a terrific job both branding and reach out and technology and teach-ins and using AI for education. Right? We talked about I talked about back office and mid office, but there's a lot of technology there that can educate people right now. And what does it do? How does it fit into my overall portfolio? So that's what I'd say, and that's what we're focused on, and just taking advantage of that demographic shift of people turning 65 in this country. And again, as you said, there's plenty of carriers, but I think if we all perform and act in a reasonably professional manner here, there's plenty of room for the folks. And again, it's not only rate, it's not only par rates and cap rates. I think it is service, and we see service as a differentiator, and we hope to always provide that to our constituents.
So you guys have done international business for many years. What are some differences between the two
Sure.
to America, and maybe is there a bridge between?
The if you looked at our product in international and you just looked at the spec sheet, you'd say, oh, this is a MIGA and this is a FIA. The big difference in international is depending on the jurisdiction where that client lives, it may or may not be tax advantaged. Some jurisdictions allow for those types of retirement products to be deferred, and others do not. So it's really in the U.S. we know how it works. Everybody's got the same tax law, whether you're in China, you're in Japan, you're in Mexico, Argentina, all of the regulatory bodies, and there's full disclosure, there's full reporting back to home jurisdictions international, just to set that record
But,
straight.
So let me back my question up a little
Yeah,
bit
go ahead.
because of course some of that is what about buyer mindset? What's the difference in the buyer mindset in the international market compared to US?
Great question. International buyer wants dollar assets because they live someplace where they'd like to have some dollar exposure,
Hmm.
which they can't get in their own home country. And they want something that, here's where it's similar, safe and quote, quote, guaranteed.
Hmm.
You're living in Argentina or you're living in Mexico City and you have investments and you could be highly successful. Our target client in international is got a net worth of between $1 to $6 million, some much more. But they've made money in their home countries doing either being a business person, entrepreneurial, and they want a portion of their portfolio outside of that jurisdiction in dollars and with an A-rated counterparty. So their real one is accumulation and the ability to give that to their beneficiaries. So that's not dissimilar to many of the
Okay.
clients in the US, but the clients in the US, um, that's why the FIA product is interesting. Our international clients, only about 10% of our business is FIA in international, 90% is MIGA because of what I've just described as what their
Yes.
focus is. Where in the U.S., folks are willing to take a little bit of, hey, I'm happy to be principal protected, but I want a little upside, and I'll buy 50% in MIGA, 50% FIA. So the real mindset is capital preservation, great counterparty, and working with a jurisdiction that is fully transparent, fully reporting. And because we're in Cayman, a great, in my humble opinion, a great regulator, so they can get full, transparency from how we're being regulated. So that's the difference. But it is used less for income in international, more for estate planning and preservation of capital, given all the things that many of our international clients have going on in parts, all around the world,
It
globally.
sounds like it's part of a diversity plan.
It absolutely is. And they bought, historically, they bought structured notes. They've bought fixed income product, but they're like, well, wait a second, my fixed income interest rates go up. I don't want a structured note. That's got some equity exposure. I pay big fees. They like that, they don't pay a load, right? We're paying the distribution partners there, just like we do here, and they get a fair rate. They can look at the rate, they compare it to the rate they get in their bank, and they go, well, that's 150 basis point premium. So
Yeah.
I'll put that money away. And again, it's a portion, right, of their.
Are they different ages that are buying that out of
No, it's
curiosity?
very similar. A little bit younger, Paul. I'd say, on average, we're seeing across that book around 60, versus what I'd call 65 or 68, maybe in a broader book in the
Hmm.
United States. But it's there, and we have and all spectrum. Then we have the same thing. We sell up to about year 80, just like we do in the States. It's not appropriate for someone. 5 years not appropriate for someone who's 85 years old. So we have the same kind of guard lines, as I say, and happy to share with you. I'll send you the rate sheet. You'd say, oh, this looks just like the stay sale, but it's a different reason people are buying it, than just as we see the majority of the clients in the United States.
Interesting. One of my favorite questions to ask is there a question that I didn't ask that I should have?
No, I mean you've asked a lot of good ones. Most, some of the folks sort of say, well, why did you decide to get into the US? We've covered that. Maybe, kind of what do we perceive over I guess the short term, medium term,
Hmm.
long term. We've covered a lot about the industry. I think, there is an increased interest in retirement product. Let's be specific, more annuities. You're starting to see, and we're not in this business, you've got RILAs, right, in 2024 overtaking variables, I think, for the first time ever. So an interesting market there that we're
Hmm.
watching. I mentioned the word phyla. I'll be careful with that, but there's some interest in that we're seeing. But really, that MIGA and FIA core product, I think there's some good tailwinds for the industry. I think
Very.
timing is everything. We can't pick the time we enter, but we did enter the market as at a reasonable time where there's interest. But it's execution, right? We have to be able to execute. I think we've seen a great number of our peers do a terrific job executing. We've seen a handful maybe have to stumble, but they've recovered. But it's hard, right? You only get one time to make that first impression. So what I worry about is us keeping up the service as we grow our business and hopefully become, a long-term uh, provider here in this market, which, you said at the start, it's exciting, right? Who would have ever said, boy, insurance, yeah, it's super exciting. Well, it really is. I mean, the insurance industry is providing, in my view, a great service. It's also got the right type of liabilities for providing, asset investment. We didn't talk about private credit. We didn't talk about all the focus on, what are insurance companies doing. Sure, there's always one or two maybe bad actors that do things they shouldn't. But I think the way the industry has been structured,
Definitely.
assets and liabilities are well matched, not where banks have on-demand deposits that can leave the next day and are making long-term commitments. So I think done correctly, this is a super exciting place to be on the liability side, as well as the asset side for folks. So it's getting a lot of good press. It's gotten some negative press in the past, but I think we're doing a good job of just proving it, right? Talk is cheap. You got to just operate and make sure you provide good service and the dollars back to your clients.
Yeah, I think that service is really important in these days. It's been outsourced, and there's nothing worse than dealing with an outsourced service. And I'm not saying, you may actually do that, but when you call the Philippines and you're getting somebody and they're in a different country, if I've got my money there, I never feel comfortable.
No, and listen, I think there's certain folks who do that terrific, and there's others who don't. You brought up, kind of that scenario. We do, we self-administer, and I'll be the first to tell you, we're not without, we don't, we've made our mistakes, but I think we've minimized those mistakes because we've been able to control our volumes, and we want to grow with our volume, right? But if there's a problem, right, if an agent has a problem, they know who to call. And I get on the phone with agents 3 times a week, not all for problems. Actually, some guys calling us saying, "Hey, we really like your story. We really like you do it," or, "Hey, I didn't get this transfer in a timely fashion. What happened?" So the good news, though, when you control your own destiny, you can fix it, and you can make sure if you have a deficit in one area, there's great TPAs out there. There's terrific third-party administrators. There's probably not so terrific third-party administrators. They've serviced some of our seeding clients have terrific service. We've decided to do it ourselves. It's costly, but I think in the long run it pays off. So that's the strategy we've undertaken here to approach the market.
Well, awesome, Ed. I really appreciated your time,
No,
your
great to meet you
insights.
virtually.
Yeah, and I'm excited for you.
Thank
Promise.
you.
All right. Take care.